Hey, this is Neil Bawa, the mad scientist of multifamily, and you're listening to the Mailbox Money Show with Bronson Hill.
All right, so this is an interview with Andrew Cushman, good friend of mine. He is awesome. He always has a very data-focused approach. If you're wondering if this is a good time to invest, we get into that. He really has the opinion that it's the best time to invest right now. And again, you'll see this in assets, in investing, when really looking back, the best time to invest was the time that no one wanted to invest, right? The best time to start buying real estate in the recent history really was 2008, 2010, whatever, but nobody was buying. And we get into that in the interview. And so right now, I mean, your buying price of a property is fixed, but your interest rate can be adjusted later. And so we're wondering, as interest rates drop, what will happen to multifamily prices? They will likely go up because there's a short supply, and when you lower the cost of those assets or the cost of money to get those assets, pricing will likely go up. So you're going to love this interview. Let's jump in without further ado. Andrew Cushman. All right, Andrew, welcome to the Mailbox Money Show. How you doing, brother?
Doing well, Bronson. Good to see you once again.
Oh, it's always good to see you, man. I always learn something, and when I see you on Zoom, I always see the all the outdoorsy stuff I should be doing, like riding skateboards and surfboards. So, you been doing much of that lately?
Not as much. I'm about to get started though. You know what I should do? In the winter, I should switch out the surfboards and put all the skis on the wall because that's what I'm really focused on. I mean, I was surfing not this month, but nowadays it's mostly skiing. So I should swap it out and have seasonal decor. So
Well, we do live in Southern Cal, so technically you can, ski in the morning and surf in the afternoon. I don't know if you've ever
I
done that on the
I
same day.
I've done the reverse. I went surfing in the morning, had lunch at home, and went snow skiing in the afternoon. Like it wasn't even that hard. You didn't have
Yeah,
to like
yeah,
go to
yeah,
heroic efforts to do it. It was like, let's stop for lunch. So yeah,
yeah.
maybe New Zealand. Other than that, I don't know too many places that you're gonna surf in not sub-freezing water and then go,
Yeah.
skiing in the afternoon. So.
Yeah, that's awesome. I love it. Well, I love your adventurous, and I know a little bit about your story, and I know you've been on this show before, and we've had you at our local meetup, which has been awesome. Give people that don't know you just a little bit of background about yourself and how you got started in real estate, and just kind of what brings you to today.
Yeah, I took the typical path into real estate, which is I went and got an engineering degree and worked as an engineer, not because I loved, that's what I wanted to do for a career. I knew as a kid I wanted to have my own company and do my own thing. I just didn't know how or what that looked like. So I'm like, well, if I become a chemical engineer, I'll always have a job and it'll always pay well, right? And then I'll figure it out. So worked as an engineer for 7.5 years, discovered flipping here in Southern California. So 2007, which was right before the great financial crisis, my wife and I flipped a condo, and we made as much as I made all year at my job. So I'm like, all right, there's no better sign than that. I'm out. Quit my job right before everything came crashing down, which was great timing because we had no competition. Flipped
Yeah.
houses for 4 years full time here in Southern California. And then, everyone else kind of started saying, wait a second, there's a good business over here. So it started getting crowded. And more importantly, my wife and I were like, hey, you flip a house, you put a check in the bank, and then you got nothing else to show for it. I mean,
Yeah.
it's a good business, but there's nothing left. She said, well, what creates longer term wealth and cash flow? And what is like, we just had a big crash. Everyone and their mother either got foreclosed on and can't buy a house for the next 7 years, or they know someone who just got foreclosed on and they don't want to buy a house because they're scared of it. So, okay, so no one's buying houses and won't be for a while. And then we just had a huge recession, which probably means we're going to have a big, long expansion. So you put those two things together, economic expansion and no one buying houses, we figured, okay, that should be really good for rentals. How do you benefit from that? Oh, apartments. And so we went and found a mentor. Our first deal was 92 units out in Macon, Georgia, and haven't looked back. It's been a great business for the last 13 years now. So.
Yeah, that's awesome. No, I love it. And you've been doing it for a while, which is great. I know you contribute on Bigger Pockets and a lot of places where you're sharing information, which you have a very you study a lot and you look at a lot of different things, and it really is interesting when you hear people that study and research and have been doing this a while, which is really fun. But as we talked about, we had you at the meetup, I think in the fall. Things look very different than they did about 2 years ago,
Oh
and
yeah.
something has happened. Some little thing about rates, increasing faster than they have in the last, anytime in the last 40, 45 years. What are some things that you've seen to change, or maybe that kind of where we're at right now? Obviously, it's harder to get deals done. But what are some things that you're seeing both from a kind of a negative and a positive standpoint from where we're at right now?
Well, speaking of deals being hard to get done, since we closed our last one, which was the spring of 2023, we have looked at 478 deals and gotten zero. Right. So,
But at least you're taking at bats. At least you're swinging the bat, right?
yeah, exactly. So one of the driving factors behind that is one of the things that's changed in that, multifamily operations are actually still quite well. Like when we look at our portfolio for December, a third of our properties set all-time high records for collections, and then the rest of them were pretty close to it. So,
Yeah.
don't get me wrong, there's challenges with insurance expense and wages and contractors and all this thing, but that's just part of the business. But overall, fundamentals are good. And so, okay, well, that's what has made the change. And like you said, it's interest rates going from, the federal funds rate effectively from 0 to 500 something in a very short period of time. That was a shock to the system. It was
Right.
too quick for anybody to adjust or plan for. And so what that did is it made it so, number one, anyone trying to buy a property, their cost of their debt doubled or tripled. And so they're like, hey, Mr. Seller, yeah, I would have paid you 12 million in January of 2022, but now my debt costs, double. So I can only pay you 9 million or maybe eight or eight
Yeah.
and a half, right?
Right.
And so but the seller, like I said, operations are still good. So the seller's like, no, I'm not selling it to you for that. I'm just going to keep it. And so the
Yeah.
market just shut down. And it has been that way almost ever since. Volume in 2023, depending on who's giving you the stats, somewhere between 20 to 25% of normal, like a
Yeah.
fifth of the normal transactions, right? So I can't tell you how many brokers I've gotten email announcements like, it's like, hey, I've left brokerage and I've gone to, some other job because they were a junior broker and they didn't have the long-standing relationships. And again, they were making a fifth of what they were previously.
Mm.
So that's a big change. And now and so again, sellers haven't been motivated. Buyers are like, I can't pay you that anymore, and so everything just came to a screaming halt. That is getting ready to shift. It is already shifting, and that's part of why I'm excited about the next couple of years because things are moving back the other way.
Yeah, yeah, absolutely. It's interesting too. I just had a panel recently with some big thinkers and talk about kind of what's happened in multifamily. Some pricing has come down a little bit, but the rates have been higher. With single family, it's been a shocker. The last couple of years, prices on average have gone up like 2 or 3% across the country, just total. And because no one wants to sell, they didn't predict that. Hey, if somebody sells at a 3% rate that they have, they're going to move somewhere else and pay 7, 8% on a new single family mortgage. But with commercial multifamily, we've seen there's an area of Atlanta. I give this example that we own in where just the same property, 2 years apart from, January of last month to 2 years prior, 24 months earlier, has decreased by 42%. Just the actual, price or value of that asset, which is really, it's tough as an operator. If you're going for like
Oh yeah.
maybe you're just trying to hold things longer. We've seen a lot of, a lot of people talk. I had a call somebody earlier that was talking about, troubled assets and have you started your troubled asset fund? And I'm thinking, I'm kind of seeing I know people started this stuff like 2 years ago, and I'm not seeing necessarily the trouble out there. And even then, I'm seeing lenders or stories of lenders that are just extending terms. They're kind of like, oh, well, yeah, obviously you can't pay, and we're just going to extend terms. Are you seeing that kind of out there where it's like things kind of get in trouble, and then it's like, well, the lender doesn't want the property, and they see the group's doing okay, and they're like, well, we're going to kind of extend you.
Absolutely. And this is why you'll never see a post or interview with me predicting doom. I can't, there is no crash coming
Yeah.
in commercial real estate. Well, okay, I'll set office aside. That's a different animal, right? And I'm not an expert in it. Actually, I'm probably not an expert in anything, but in terms of multifamily, where I have the most knowledge relative to me, I would say number one, price declines are done. Like we're not going down any further because operations are still quite good. And the really the only driver behind price declines was the rapid rise in interest rates, just the cost of debt. People still want to own multifamily, but they're like, well, my debt is more expensive, so I have to pay you 30% less. And then, sellers are like, well, I'm not going to take that. And so that's what's led to the price decline. But almost nothing has traded.
Right.
And so there aren't comparable sales. And what we're seeing in real time is properties that we're bidding on. And we actually sold one recently. We had 16 offers on the property that we sold. We did not have any difficulty selling that property, and we hit our target pricing. And we're seeing the same thing on properties that we are trying to buy, even off market, where they're going for at least what the target number was, and in some cases even more. Part of the reason for that being interest rates have stabilized. Markets hate nothing more than uncertainty. And the Fed has now come out and said, hey, we're done raising rates. And now the market's like, okay, interest rates have kind of come back down. So if you get the 10-year, it's come down about 90 basis points from the high to where it is trading about today.
Yeah.
It seems pretty likely with an election year coming that we're not going to, our government's not going to do anything to cause a major disruption. The Fed is
Right.
saying we're leaning towards cutting rates. So basically, what does that tell us? Well, that says 2024, the biggest cause of problems in the market is likely stabilized with a improving trend. And so that gives us a little bit more certainty. We're going to see buyers come out. And also now we know what the rules to play by. How do you underwrite a property when interest rates are moving 50 basis points every 2 weeks? Right? You don't know what your going in interest rate's going to be. Like how do you pick an exit cap? Like all this stuff just goes out the window when it's bouncing like crazy. Now that that's starting to settle out, that's going to help loosen the market up. But also in terms of, you mentioned seeing a property trade 2 years ago versus now, we've seen the same thing. And those properties are, if we say the peak pricing for multifamily was January of 2022, I'd say we're off anywhere from 20 to 35. I'd say 40 is probably an extreme, but call it 20 to 40% in real time. The headlines don't reflect that yet because comparable sales are looking in the rearview mirror. Right. So since there hasn't been a lot trading, it hasn't been in the headlines like, oh, this is down 30%. In real time, it feels like the bottom is in because number one, interest rates have stabilized, and that was what really caused the decline. And then number two, there is so much dry powder, so much capital on the sidelines waiting for that traffic light to turn green that there is not going to be enough volume of deals coming to market to overwhelm the capital ready to suck them up and absorb them. So to me, the bottom is in. I'm hoping we stay at bottom for at least 12 to 18 months so we can acquire some properties before things start heading back up. But I mean, just one quick, you've mentioned people raising funds and rescue funds and all this stuff. Just the money market funds in the United States from pre-COVID to now, the long-term balance in money market funds was about 3 trillion. You want to guess what it is today?
I don't know. 5 trillion?
6.14 trillion. According to the St. Louis Federal Reserve at the end of Q3 2023. So $3 trillion of cash went into these funds because, hey, now you can get 5%. What happens when interest rates come down? Well, that money's not earning anything. Where's it going to go? Alternative assets, things like Bitcoin, real estate, and all that. Just give a perspective that the GDP of the world's third largest economy, Japan, is 4.2 trillion. So there is more money, about almost 150% of the GDP of the world's third largest economy sitting in accounts ready to be deployed. So again, once the market senses that opportunity is there, those two things are going to put the bottom in.
Yeah, it's a really good point. Now, I know for a lot of people listening to the show are investors, and we talk about a lot of different assets on the show, and a lot of people have been hurt by multifamily. And so there's been capital calls. One investor call a few months ago. I'm in 5 different capital calls right now. And there's just kind of this like distaste for multifamily, but it could be that and this is, Warren Buffett talks about fearful when others are greedy and greedy when others are fearful, that the best time to buy is the time of maximum pessimism. And I'm seeing some pessimism, particularly from retail investors, not as much from like larger investors, but especially retail investors. What would you say to a retail investor that has seen challenges in multifamily? I mean, do you think we could look back on this time and say this was the perfect time to buy because rates were higher, and as rates do drop, as we predict they likely will, your asset buying price is fixed, but the interest rate can be adjusted later. What would you say to an investor who's kind of really cautious? Like, I've been hurt, therefore multifamily is bad, right?
Yeah, I mean, you summarized it perfectly. Now is the time, and like when there's pain, when people have gotten hurt, when people are scared, when people are done with it, that is the time to be investing. You flip that narrative, go back to end of 2021 and the first couple of months of 2022, it was the opposite, right? Multifamily was great. Everyone you knew was doubling their
Yeah,
money, tripling their money. Well,
right.
that was the worst time in a over a decade to get in. And so like now it's like you said, everyone, oh, I lost money, I'm getting capital calls. That tells you it's the time to get in. And
Yeah.
I really do think that anything that is bought at a good basis with reasonable cash flow today or this year or next year and held until 26, 27, and 28 is going
Yeah.
to end up being a really good investment.
Yeah, absolutely. I think that's good. And I think a lot of people, it's hard to see, we've done a lot more cash flowing type of alternative assets now because that's what a lot of folks have wanted. Are you seeing, in general, a lot of cash flow kind of be absorbed right now just from interest costs and expenses and other things where it is kind of a funny time to invest, right? Where it's like things that were cash flowing are not cash flowing anymore for some cases. And because of interest rates and other expenses. Are you seeing that as well, or that's kind of pretty common?
It's common for anyone who didn't hedge against interest rates going up.
Hmm.
So yeah, you mean there are properties where the actual fundamental operations of the property are just fine. The property's not distressed, but it's stressed because of what you said. They have a floating rate loan. It wasn't capped. And so their interest rate payment might have gone from 70,000 a month to 170,000 a month, and the property doesn't produce enough cash flow to pay for that. And that is what is going to lead towards opportunity in 2024 and 25 is those operators are going to have to sell because the values come down, so the LTV is not there. They can't refinance. There's not enough cash flow to there was enough cash flow to support a loan at 3, 4, maybe 5%, but not 6, 7, or 8. And so that those properties have to be sold. And the key nuance is, as an investor, that is only a problem for the people who currently own properties. It's not a problem if you're looking to buy properties
Right.
because you're going to buy at the right price that matches the interest rate that you're going to get on your loan. It's only a
Right.
problem for the guy who bought 2 years ago, counted on a 3% interest rate, didn't lock it in, and now it's 7 or 8 or 9. So that's
Right.
another thing too. All these scary headlines, it's not a problem for the new investor. It's only a problem for the guys who are already in.
Yeah.
And if they didn't plan for it or they don't have a way to solve it. So, and again, and if you're an LP who's listening to this saying, yeah, well, it's a problem for me because I've lost money in 3 syndications, that is true. And we're not minimizing that. What we're saying is going forward, it's the interest rates aren't an issue because you're going to be buying and investing with that already factored in.
Yeah. Yeah. It is interesting when, it's you have to kind of look at it two ways, right? One as an owner or as somebody potentially selling, or what also look at it as a buyer. Well, if
Hmm.
it's is it a time to double down? And this is the part I think of psychology where most people are not good investors because when things are going really well, they should be taking chips off the table and thinking about, okay, what happens when this turns, and not necessarily selling, but just what does that mean? And then when things are not going well or things have crashed, it's probably a time to double down. And it's just like if you have a stock and it's gone to half the price, it's not time to sell. It's time to really look at the fundamentals and think, is this a great investment, and double down on it? But how much do you think the wealth effect has affected where people have seen losses in other areas and they kind of, maybe went from feeling kind of wealthy, there's all the money floating around, the PPP, you had all this, just so much money, and there still is money. I think a lot of it, you mentioned, I think a lot of it's institutional and larger groups, but I know a lot of kind of upper middle class people are kind of like they're not feeling as wealthy as they were a couple of years ago. So are you seeing a kind of wealth effect in some of your deals where it's like, hey, we were raising several million, now we're raising $1 million. It's changed a little bit as far as being able to raise for some of these deals right now.
We have seen that. However, I'm telling you, it is still far, far easier to raise both debt and equity now than it was in 2010, 11, and 12.
Yeah.
I mean, it was nowhere to be found back then. Now everyone is like, oh, hey, there's a big opportunity coming. We're ready.
Yeah.
And now, and with that said, it is, I'd say, a little harder to raise equity these days. But candidly, the right deal that's being bought at a good basis and has a good business model and has well mitigated risk, those deals are still getting funded pretty well. And here's why. The money raising capability or ability of sponsors of all kinds the last few years, that was not normal. It really
Mhm.
should not be that easy. I mean, just people were, rushing to throw money into all kinds of stuff. I mean, I remember hearing stories of people paying, 5 figures for virtual real estate in the metaverse.
The
Right.
metaverse, right?
And just think about the NFT craze and how much people paid for some of that. I mean, that's just a
Yeah.
sign that there's just too much money out there. So yes, relative to that, equity is definitely harder to raise today. However, I would say what we're seeing now is a reversion to the healthy mean, meaning people do have money to invest, people still are looking to invest, but rather than just like, okay, I gotta get in before everyone else does,
Yeah.
there's more of a healthy sense of pause and caution. And I think that is actually good for the long-term health of the market, and for investors, that there's a little bit more caution and it's a little bit harder. So yes, it is harder now, but again, in my experience of doing this, it's actually not hard. It's just back to normal.
Yeah. And that's why I think where experience really helps you, because you've been through multiple eras here where it's looked different, and it actually is easier compared to other things. And I think syndication just in general, some of the laws changed. I think it was for the 506B or 506C, they changed some of the laws where it just made much more accessible right about that
They
time, right
did.
about 2011, 2012, somewhere in there. And so it just this huge flood of people into it. I still think that 95% of people that should be investing in syndications haven't really heard of it. And so what do you think are some other you're a multifamily guy. Are there other assets you like inside of real estate or even outside, and other alternative assets that you personally are like, oh, this is really interesting that you're looking at?
Yeah, so I've chosen to focus, so in terms of our business, focus solely on very narrow specialty. So B to A minus class garden style multifamily in the Southeast United States, right? Like that's a very specific thing. Like Warren Buffett said, put all your eggs in one basket and then watch that basket very, very closely. However, that doesn't mean that that's the only good investment out there.
Yeah.
I'm not an expert in these other classes of investment, but to me, industrial is probably, seems like there's a lot of opportunity there. Self-storage is a bit overbuilt right now, but long term, probably a pretty good investment. I know a lot of people who've seen are just crushing it in car washes of all
Yeah.
things. Um,
Yeah, we've done some car wash stuff as well. Yeah, really it's the private equity roll up, right? You're building more
mhm.
car washes and you're trying to sell it at a higher multiple in the future to private equity.
Yeah, laundromats. It
Yeah.
seems like laundromats are incredibly well-performing assets. Office. I would make sure you really know what you're doing before you go into that, because that is what's happening in office is not your typical economic cycle. That is a structural shift.
Change.
In
Yeah.
in in that's a very different thing. And so be really careful with that. Even Bitcoin and some of these alternative assets, I do think there's a place in a diversified portfolio for all of these things. And if I was going to be retired and doing nothing but managing my own passive investments that I place money with other people, I would place the bulk of it with multifamily, because number one, I understand that best, and number two, AI and all these other things are not going to ever change the fact that people need to live somewhere physically and have a roof over their head, right? So
Yeah.
I know I'm not going to be put out of business by some new tech that comes along,
Yeah.
but I would, find some great operators with, car washes and diversify a bit. So yeah, I think there's definitely other opportunity out there.
Yeah, that's great. No, I think it's I think it's good. It's great to pay attention to what's happening because there's always opportunities in every market. There's always things to look at. What are some other? I know you do a lot of research, but what are some other unusual things you're seeing? Kind of coming back to multifamily, just of the markets that these are things that most people aren't aware of that can potentially help or kind of give it a perspective as far as investing.
I'll give you an interesting one. This was just a couple of weeks ago. It is almost Bronson. It's almost. I think that the last time we met in person,
Yeah.
this would have been like a rumor. And 2 years
Hmm.
ago, it would have been unfathomable to even consider this. We just saw a lender approved short sale on a multifamily portfolio, meaning the price that the properties are being sold at is lower than the balance of the debt. The seller said, all right, we're going to go with this buyer. Then they had to go to the lender to get the lender's approval. And the lender actually said, no, we were going to pick a different buyer. And so the lender chose the buyer and approved a short sale. And so that's good. That
Wow.
transaction is going through.
Yeah.
I mean, again, 2 years ago, in the height of the multifamily, in particular, multifamily craze, the idea of, wait, you're gonna have to get your bank's approval to do a short sale on a multifamily, like, that was crazy. We just saw that happen.
Yeah.
So
Right.
that's part of why the market is not, in my opinion, likely to crash or continue down. Lenders still remember 2008 through 2012. They figured out, oh, we don't want to take these things back. Right. So they're going
Yeah.
to approve short sales. They're approving another one. We've been seeing a lot in the last like 3 to 6 months, even, of lenders extending loans
Yeah.
and waiving covenants to do so. Basically, and meaning that, you know, we a lot of owners and syndicators in particular take these loan extensions for granted. Like, oh yeah, I'll just extend the loan. There's like 87 rules
Yeah.
and hurdles you have to clear to be able
Yeah.
to extend that loan. And 99% of properties these days don't meet those requirements. So typically the lender would be like, tough cookies, pay me off.
Yeah.
Instead, a significant percentage of them are saying, you know what, don't worry about it. We know you don't qualify. We'll just extend it anyway. Right? They don't want to take it back. They don't want to make
No,
the
I don't want
situation
it
worse.
back.
And
Yeah.
so they're extending. In some cases, it's extend and pretend, but in other cases, it's like, if they say, hey, look, we got a strong operator,
Yeah.
property's in a good location,
Yeah.
a few years from now, this is probably going to be fine. You know what? Let's just extend this loan and hope everything works out. Right now,
Yeah.
hope is not a business plan, but if it's coupled with some research and data and in reality, then that can work. And so again, that is going to help differentiate this from last time, is the lenders learn to not just foreclose and take it all back.
Yeah. Yeah, that's a big deal. I mean, it's really, I think in every market there's always lessons, and it kind of what you're saying too reminds me of the contrarian, being a contrarian, being willing to look at things differently, being willing to go against the crowd. Even there's some spiritual teachings on this. Even Jesus says, like, wide is the road to destruction, and many, go that path, but few. And it's kind of like it's the most unnatural thing to, like, when everyone's getting into something, to be like, maybe it's time to get out of this, or maybe it's time to, like, restructure, take some chips, to do that a little differently. Yeah, I think that's really good. Well, Andrew, I think we could talk about this for a really long time, and I always appreciate you because I feel like you have a great perspective when it comes to just your experience, as well as just really guiding people to understand what's happening today. Because a lot of people are like, I don't know what to do. So just want to honor you for that. Appreciate you, all the value you're bringing. I encourage people to check out your Bigger Pockets episodes as well that you're doing. You have a lot of media stuff that you're involved with. But how can people reach out to you, connect with you, follow what you're doing, and be a part of the deals that you guys are doing as well?
Yeah, two main ways. If you're interested in potentially being part of the deals or at least seeing them, just go to you can Google Vantage Point Acquisitions or Andrew Cushman. Everything comes up, and just go to the website is vpacq.com, and there's a tab on there. Just you can fill out a short form, and then that'll send you a link to schedule a call with either myself or Anthony. That's to have a phone call with us and potentially get on the investor list. If you just want to kind of connect and have social media conversations, I have decided I'm not doing any social media except LinkedIn.
Uh-huh.
So I do consistently post and comment on LinkedIn, and if you comment on one of my posts, that actually is me responding to you.
Okay.
So if you want to have a conversation about a topic, that's probably the best way to do it, is just connect with me on LinkedIn.
Awesome. Maybe I'll start writing comments on your LinkedIn, and then I can start chatting with you, or I can
That'd
text
be
you. I guess.
great. Yeah.
That'd be awesome. Awesome, Andrew. Well, appreciate you, brother. Thanks for being here. I look forward to connecting again soon, and I appreciate all the value you are adding to this conversation.
All right. Good talking to you, Bronson. Thanks.
Thanks. Okay, so love this interview with Andrew. Again, super positive guy, really trying to help folks and on their way. And he gets into a lot of data, gets kind of in the weeds on some stuff, which is important, right? It's important to make sure that you understand that you have a plan and the plan that you want to go for. So, a lot of people, it's just simply they want to buy, or if multifamily has had a loss, well, the multifamily must be bad. I think it's a great time for multifamily. It has gotten harder to raise money for multifamily deals. We're seeing fewer of them available. He said 25% of the volume we saw a couple years ago. But I think it's a great time to keep looking and be looking at these opportunities, because in the moment, and I've said this for a long time, once rates start to, not even just go way down, but start to come down a little bit, we're going to start to see a lot of this money, the $6 trillion on the sidelines, start to make its way back, right? Not right away, but over time, it's going to happen. And so just be ready for that. If you haven't joined our investor club, you can check that out at bronsonequity.com. You can also check out my book right here, Fire Yourself, available on Amazon. And you get the free first couple chapters at my website if you would like to check it out. And thanks for taking the time to educate yourself. Look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.